The United States today carries a national debt measured not in billions, but in tens of trillions. It's a number that has grown faster than the American economy for more than a decade, accelerating after the 2008 financial crisis and exploding again after the pandemic. Even in years when GDP is rising and unemployment is low, Washington still runs deficits so large that the debt curve climbs almost vertically. To understand where this places America, you have to zoom out. Compare the nation's debt-to-GDP ratio to the great historical inflection points: the peak of World War II, the inflation battles of the early 1980s, the collapse of 2008, and the extraordinary fiscal expansion during COVID-19. The current level stands near the highest in U.S. history, and projections show it rising steadily through the 2030s and beyond. But the problem isn't only the size of the debt, it's the price of carrying it. Higher interest rates have pushed annual interest payments to levels rivaling the nation's biggest programs: Social Security and Medicare. Within a few years, the U.S. may spend more on interest than it does on national defense. And with most federal spending locked into mandatory programs, shifting money away from these obligations is politically impossible. The Congressional Budget Office has run the numbers repeatedly, and the result is the same. Under current law, the debt trajectory is unsustainable. Even modestly higher real interest rates compound the problem, pushing the nation toward exponential debt growth. There is no steady-state scenario left in the current system. Traditional solutions don't work. Raising taxes on the wealthy doesn't generate enough revenue. Raising taxes on the middle class is a political non-starter. Cutting spending faces similar barriers. Entitlement programs are untouchable, and deep cuts risk triggering a recession that would only worsen the fiscal outlook. Growth alone can't solve the problem either. The U.S. economy is expanding at roughly 2% annually, far below the pace needed to outrun the debt. And default is not an option. Treasury bonds sit at the center of the global financial system. Pension funds, insurance companies, foreign central banks, and money markets are all built on the assumption that U.S. debt is risk-free. A default would break not only America's credibility, but the international monetary order itself. Historically, nations have used financial repression, forcing interest rates artificially low and trapping domestic savings to erode debt. The U.S. used this playbook after World War II. But in a globalized, digital economy with freely moving capital and inflation targets firmly anchored, those techniques no longer work the way they once did. The federal government still holds powers households do not. It can issue the currency, redefine what that currency represents, change accounting standards, and revalue the assets on its balance sheet. And because the dollar remains the world's reserve currency, used for energy trade, international settlements, and sovereign reserves, the U.S. can take actions impossible for any other nation. That brings us to a different solution. Instead of paying the debt down dollar for dollar, the government can reduce the real burden by revaluing strategic assets it already controls: gold, crypto, and other reserves, altering the balance sheet from the top rather than the bottom. It's not theoretical. It's a technique with historical precedent, and one that is quietly resurfacing as America confronts the limits of traditional fiscal policy. When economists talk about a monetary reset, they aren't talking about a single policy or a one-day event. They're describing a structural rebuild of the entire monetary framework, something nations resort to only when debt becomes too large, the currency too rigid, or the old system too fragile to sustain growth. A reset can involve redefining the monetary standard, revaluing the assets the government holds, or altering the way national liabilities are measured.
Historically, these resets appear in moments of crisis, when the debt burden crosses a line that can no longer be managed by conventional tools. One of the most powerful mechanisms inside a reset is the revaluation of reserve assets. When a government raises the official value of gold, strategic minerals, or even digital assets it holds, the change ripples through its entire balance sheet. Suddenly, the asset side strengthens, net worth increases, the ratio between debt and national assets improves, and because financial markets perceive the sovereign as more solvent, its borrowing costs fall. It is the economic equivalent of rebuilding the foundation of a house without touching the visible structure. This approach differs sharply from simply paying down the debt. Paying debt means reducing the nominal number. Reducing the real burden means lowering the value of the currency in which the debt is denominated, making every dollar of debt easier to retire in the future. Devaluation works because the liabilities stay fixed, while the value of real assets, incomes, and nominal GDP climb relative to them. We've seen this before. In 1933 and 1934, during the depths of the Great Depression, the U.S. government raised the price of gold from $20.67 to $35 an ounce. Overall, the value of America's gold reserves surged. The federal balance sheet strengthened without Congress slashing spending or raising taxes. That move laid the groundwork for economic recovery and remains the clearest historical precedent for a modern reset.
For a revaluation to work, the assets involved must be difficult to manipulate. Gold fits that requirement. Bitcoin, with its fixed supply schedule, may as well. Strategic commodities that cannot be mass-produced also qualify. Their scarcity creates credibility. Markets believe the new valuation because the government cannot flood the world with new supply. When these assets rise in value, and when the dollar weakens relative to them, the nation's debt-to-GDP ratio improves from both directions. The balance sheet becomes stronger, while nominal GDP expands. But there is a cost. Devaluation tends to bring inflation. Prices rise, savings lose purchasing power, and the shift happens slowly enough that most citizens don't see the reset happening until it's already in motion. This kind of revaluation also requires legal and institutional coordination. Treasury must have the authority to change statutory gold pricing or define how digital reserves are accounted for. The Federal Reserve must align monetary policy with the new valuation so the reset doesn't destabilize markets. When both institutions move in sync, the transition can be managed quietly and effectively. And the current moment is unusually ripe. Post-pandemic debt is enormous. Growth is subdued. Interest rates remain elevated. Around the world, countries are diversifying reserves and challenging the dollar's supremacy. Against that backdrop, the United States may once again turn to a method it has used before, strengthening its balance sheet not by reducing the debt, but by redefining the value of the assets that back the American financial system. In the early 1930s, the United States looked nothing like the confident superpower we know today. The nation was deep in the Great Depression. GDP had collapsed. 1 out of every 5 Americans was unemployed. Bread lines stretched down city blocks. Banks failed by the thousands, and waves of panicked depositors emptied their accounts in desperate attempts to salvage what little remained. Deflation, prices falling year after year, crushed wages, tax revenues, and the value of nearly every asset an American household owned. Layered on top of this economic devastation was a rigid monetary system that tied the U.S. dollar to gold at a fixed price of $20.67 per ounce, a valuation unchanged since 1879. Under normal conditions, a gold standard imposes discipline. But in a deflationary collapse, it becomes a straitjacket. As the economy shrank, the supply of gold-backed money failed to grow with it. The federal government needed to expand the money supply to restore demand, but the gold peg made that nearly impossible. Even as public debt increased through emergency relief spending, Washington couldn't respond with the monetary tools needed to stabilize the country. That is the backdrop for one of the most controversial and consequential decisions in American financial history. In 1933, President Franklin Roosevelt issued Executive Order 6102, requiring U.S. citizens to turn in their gold to the government. Gold coins, bullion, certificates, all had to be surrendered. The goal was simple: concentrate the nation's gold supply inside the federal vault so the government, not individuals, controlled the monetary anchor of the American economy. Only after the government had secured the nation's gold did Roosevelt execute the real reset. In 1934, the official price of gold was raised from $20.67 to $35 per ounce, a 69% increase. Overnight, the value of America's gold reserves skyrocketed. What looked like a simple revaluation on paper was, in reality, a monumental shift in the government's balance sheet. Suddenly, Washington possessed far more asset value with which to support the financial system and fund economic recovery. The effects were immediate. The nominal burden of federal debt remained unchanged, but its real weight fell, because the dollar itself had been devalued relative to gold. As the money supply expanded, deflation slowed and reversed. Prices rose modestly, lifting wages and corporate revenues. GDP began to grow again, helped by the New Deal's fiscal programs, now backed by a stronger federal balance sheet. There were winners and losers. The government benefited enormously from its newly enriched reserves. Savers holding cash saw their purchasing power erode. But the financial system stabilized. Banks regained credibility. Capital returned to the markets instead of hiding in vaults. Across the country, a sense of motion, of economic life, returned. This episode remains one of the clearest examples of reducing debt through devaluation rather than repayment. No defaults, no crippling austerity. Just a recalibration of the monetary system powerful enough to lift an entire nation out of paralysis. And for policymakers today, facing debts far larger than Roosevelt ever imagined, the lesson endures. Sometimes the only way to restore stability is not by shrinking the debt, but by redefining the value of the system beneath it. In the modern financial landscape, the United States finds itself holding a surprising kind of strategic asset: vast amounts of cryptocurrency it never purchased. Through federal investigations, Silk Road, Bitfinex, ransomware takedowns, darknet seizures, the government has quietly accumulated one of the largest Bitcoin reserves on the planet. These assets, measured in the hundreds of thousands of coins, sit under federal control not because of investment decisions, but because criminals forfeited them. And the inventory keeps growing. Every year, federal agencies seize more digital assets through prosecutions, civil penalties, and financial crime enforcement. This creates a dynamic no other nation enjoys: a digital reservoir of value expanding automatically through law enforcement rather than taxation or borrowing. Some lawmakers have begun to notice. Proposals have surfaced calling for a strategic Bitcoin reserve, modeled loosely on the nation's strategic petroleum reserve, to formalize these holdings as a sovereign asset. The idea is simple but powerful. If gold can be a reserve asset, why not its digital counterpart? Behind this movement is a network of federal institutions, each playing a specific role. The Department of Justice leads high-profile asset seizures. The IRS tracks and recovers unreported crypto income. The CFTC oversees crypto markets as commodity exchanges. And once these assets are secured, the Treasury becomes their custodian, deciding how, when, and whether they are liquidated or held. Increasingly, the trend has been to hold. But digital assets are only half of the story. America still controls the largest official gold reserves in the world, more than 8,100 metric tons, stored in places that have become symbols of national strength. Fort Knox, the Denver Mint, and the vaults of the New York Federal Reserve. The gold sits on the federal balance sheet at a statutory price of just $42 per ounce, a number frozen since the early 1970s. Meanwhile, the real market price hovers 50 or 60 times higher. That gap represents an enormous technical cushion. By simply revising the statutory valuation to reflect market reality, the United States could add trillions of dollars of asset value without mining a single new ounce. Few scientists have this kind of accounting leverage, and fewer still hold both vast physical gold reserves and growing digital asset reserves. Together, they form a dual framework, a two-pillar reserve structure capable of supporting a future financial reset. Global trends are only intensifying the strategic importance of these assets. China and the BRICS nations are buying gold at historic levels and exploring reserve currencies outside the dollar. Some nations are experimenting with digital assets as sovereign stores of value. The world is not abandoning the dollar, but it is diversifying away from it. For Washington, defending the dollar's position means demonstrating strength not only in its economy, but in the assets that anchor its credibility. That is why America's swelling holdings of gold and crypto matter so deeply in the current moment. The country's debt is rising faster than its economy. Interest costs are exploding. Traditional fiscal tools are losing traction. And so, slowly but unmistakably, the United States appears to be assembling the components of a new strategy, combining the timeless solidity of gold with the emergent scarcity of Bitcoin to reinforce the foundation beneath the world's reserve currency. What looks like a patchwork of seizures, regulations, and accounting quirks may in fact be the early architecture of a future financial realignment, one in which America's oldest reserve asset and its newest rise together to support a system under historic pressure. As the United States confronts a level of debt unmatched in its history, policymakers are beginning to revisit a tool that has reshaped the nation's financial destiny before: the strategic revaluation of reserve assets. Gold, Bitcoin, and other stores of value that carry mathematical or geological scarcity. The question is no longer whether such a reset is possible, but how it might unfold in the decade ahead. One path would be the simplest: changing the statutory price of gold. Today, America's gold reserves are still recorded at roughly $42 per ounce, a number frozen since the Nixon era. By lifting that statutory price to a level that reflects modern market reality, the government could add trillions of dollars to its balance sheet without lifting a pickaxe or minting a single new bar. A more gradual approach is also possible: a crawling peg system that adjusts the price of gold upward over time, guiding markets toward a controlled revaluation rather than a shock. Or Washington could pursue a one-time leap, a sudden shift in the official price that rewires the financial system overnight, much like Roosevelt's move in the 1930s. A similar approach could be applied to crypto reserves, especially Bitcoin. As federal seizures accumulate, the United States now finds itself holding a digital treasury that few nations can match. To harness that value, a new legal framework could define how Bitcoin should be priced as a sovereign reserve asset. That price could follow market averages, or it could reflect a strategic valuation, effectively treating Bitcoin as a digital monetary base, the 21st century counterpart to gold. Behind both strategies lies the power of federal accounting. By shifting from historical cost to fair market valuation, something private companies do every quarter, The government could reflect the true worth of its reserve holdings. The amount of gold or Bitcoin would not need to change. Only the numbers in the nation's ledgers would. Yet those numbers would dramatically strengthen the Treasury's position, immediately improving its debt-to-asset ratio and lowering borrowing costs. This transformation would also ripple through the Federal Reserve's balance sheet. Higher reserve values would give the Fed more room to expand liquidity in moments of crisis, restoring a flexibility that has eroded over decades. At the same time, a weaker dollar, an expected byproduct of revaluation, would lift nominal GDP, pushing the debt-to-GDP ratio downward from the other side. Of course, a monetary reset is never painless. As the dollar softens, import prices rise. Inflation ticks upward, reducing the real value of savings and treasury bonds. For international holders of dollars, the erosion of purchasing power can feel like a silent tax. Yet this is the essence of a soft default. The government honors every bond payment, but the real cost of its obligations quietly shrinks. That's why timing and communication matter. A rapid or aggressive revaluation could destabilize markets and trigger fear. A phased, carefully managed approach, backed by coordinated moves from the Treasury and the Federal Reserve, would offer stability while steering the system toward a new equilibrium. Swap lines could shore up global liquidity. Interest rate policy could contain inflation. And strategic messaging could frame the reset as a modernization of America's reserve structure rather than an act of desperation. The United States has performed this kind of monetary surgery before, and as the pressures of the 21st century mount, it may again choose to reinforce its financial foundations, not by shrinking the debt, but by redefining the value of the assets that support the American monetary order. No one knows exactly when a monetary reset begins. History teaches us that these transitions often look quiet at first, mere accounting adjustments, minor legal updates, subtle shifts in language from policymakers. In the short run, perhaps over the next 1 to 3 years, the United States could begin with soft steps, updating reserve accounting rules, defining how digital assets fit into federal balance sheets, and experimenting with the early legal architecture for a future digital dollar. Nothing dramatic, nothing that would alarm markets, but all of it laying the groundwork. By the mid-2030-50s, however, more decisive moves could emerge. Modest revaluation of gold or Bitcoin, small enough not to shock markets, but large enough to improve federal balance sheets, could signal that the reset has entered its operational phase. Over a longer horizon, stretching into the next decade, the nation could consider something even broader, restructuring the monetary system itself, or introducing a modernized USD, a version engineered for an economy where digital value and geopolitical competition define power. But resets rarely wait patiently for policymakers. Sometimes the trigger comes from crisis. A deep recession could erode tax revenues and spike federal spending. Soaring interest costs might push the Treasury into an unsustainable corner. A revolt in the bond market, where yields suddenly surge and investors demand a premium to hold U.S. debt, could force the government to act sooner rather than later. America's borrowing machine depends on confidence, and when that confidence shakes, resets move from theory to necessity. The Treasury market sits at the center of this drama. If global investors grow uneasy as the debt-to-GDP ratio climbs toward historic extremes, higher yields could strain federal finances. With foreign buyers already reducing their exposure, liquidity risks become real. In such moments, the Federal Reserve faces a pivotal choice: defend the existing framework at all costs or redefine it. That could include expanding its balance sheet aggressively, adopting a higher inflation target, or rethinking the very concept of a neutral interest rate. Congress, too, becomes unavoidable. Any formal revaluation of gold would require legal adjustments. Recognizing Bitcoin or other digital assets as strategic reserves would need new legislation. And the launch of a digital USD, a currency embedded in federal payment rails and secure blockchain infrastructure, could only happen with broad political approval. For ordinary Americans, the consequences would not be evenly distributed. Those holding real assets, homes, land, shares of resilient companies, gold or Bitcoin, would likely see their wealth rise with devaluation. Those holding cash or long-term bonds would see purchasing power erode. Inequality might widen unless policy cushions the shift. Markets would feel the reset as well. Stock indices might rise with nominal inflation, yet volatility would surge as investors reposition. Real estate could soar, but affordability would suffer. Pension funds would be forced to rebalance in ways unseen for generations. Globally, the reset would reshape competition. China's gold accumulation and BRICS de-dollarization efforts would meet in America reinventing its monetary arsenal. A new USD, faster, transparent, digitally native, could strengthen U.S. leadership or, if mismanaged, accelerate global fragmentation. And hovering over everything are the unpredictable forces of the future. Breakthroughs in AI, geopolitical shocks, banking crises, political volatility. These variables can accelerate or derail any strategy. One truth remains. When debt grows faster than an economy can sustain, and when traditional tools fail, nations turn to the oldest remedy in the book, revaluation. It is not an act of failure, but an act of preservation. And as America faces the pressures of a new era, the tools of the past may once again shape the path forward.